Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
Let's say, for example, that we'd done that. We're going to do a really, I'll do a really easy example here. Let's say at the time we were evaluating, trying to take a counter position to equities. So, maybe we buy an out-of-the-money call. And, before the big decline of the 1st of May, and the market's hitting those profit targets on the upside, we've got a little bit of we've got a more robust bias to the downside here on the dollar-yen, or YUK. So we have a potential opportunity. Traders may have done things. Let's say, for example, you'd bought the 94 puts expiring in July. Well, the 94 puts would cost at the time about $1.10, and they're currently worth about $5.50 or $5.25 or so. So we have the same kinds of big upside potential with an out-of-the-money option if we're able to hit our timing correctly with just a generic long put position. So pretty simple. And at the time, the equities were on the rise, so volatility was actually fairly low across the market. And that was true too of Forex options. We didn't see volatility really ramping up. But that's not true right now. So we're seeing some major adjustments across the market, and stocks as well as currencies. Volatility's way up. So, and specifically, implied volatility starts to translate into a higher premium in the Forex market. So we have in the currency options. So we have kind of this problem that we're dealing with right now, where we may want to continue to apply some hedges, but how do we handle that problem with an increase in implied volatility? And so, because it makes the options really expensive, and if implied volatility crushes out of the market, if it suddenly drops out of the market, we could have a position where we're buying puts, let's say, on YUK, and YUK actually does drop, but volatility comes out of the market, and those option premiums begin to decline. We could wind up actually being a loser, even though the market trended the direction that we forecast. So there are a couple of ways in which we might think about that particular problem. And so as I go through a few trading examples today, I want to bring up some suggestions as to how would I handle that problem today if I were looking for opportunities to diversify into the currency options, or hedge into currency options as a way to protect against additional downside in the market, or to take advantage of specific situations that are occurring in the market today. So YUK is an example. Let's say that today I'm looking to make a trade here, and I want to take a long put position. So very generic. This is really basic. And so let's say that I buy a put that expires in July, give myself 45 days or so before expiration. I guess a little bit more than that, isn't it? But pretty close. And at the 90 strike price. That particular put may cost me, $1.95. That was the price that I pulled just before the market closed. So $1.95 for that particular put, and it gives me a fair amount of time before expiration for the market to move my direction. And in fact, I know that if I were to hold this position all the way through expiration, I know that the market would have to close at least $1.95 below that strike price in order for me to break even. So I'm probably looking for something in the 88 range if I were to hold this all the way through to expiration. I don't have to do that, but if I were to do that, I'd want to be able to say that there's a probability that prices are going to break down below 88. Now, currently we have some fairly strong support there, so I might actually even wait for support to be broken before entering a trade like that. But if you're not as concerned about timing the market or using a support level to trigger your trade, then it wouldn't be unreasonable to take on a position like this, attempting to profit from further declines in the market in general. So, or I should say, from further from the market sentiment continuing to go the way that it has been going, which has been fairly poor. Investor fear is very high, and so traders are moving out of risky investments into safer investments, and that's likely to sustain this particular trend that we're seeing here on YUK. But back to the price of that particular option. If we were to buy a put option here on YUK at the 90 strike price, and we were to pay $2 or $200 per contract, it's a pretty stiff premium, which is high historically compared to, because volatility is so high. So implied volatility is really high. That's kind of amplifying that time, the hazards of time value. One of the ways in which we might approach this particular problem is to, maybe make this trade, we're still speculating to the downside, but take this trade out of the money. Now, so here's a specific example. What if we were to evaluate the 87 strike price? Which would be, something similar to the example that I used back here in late April. So the prices that are quoting late April was an out-of-the-money option in that case as well. So we're buying an out-of-the-money option here, and instead of costing us $1.95, so we have a $1.95 of time value to lose. We've got 95 cents, so about $1. Now, the trade-off there between the lower cost to enter the trade versus being out of the money is, of course, we have the increased risk that this particular option is going to expire worthless, and in fact may never become worth any money. We may not have salvageable value if we let it run too long. So we're exposed to some of the same problems, but on the other hand, we know in advance what our maximum risk is, which is limited, of course, to the price that we paid for the option. So the takeaway here is two things. We've got an option that acts and trading Forex options or currency options is very similar to trading equities or equity options. So they work in very much the same ways. We have similar trade-offs with at-the-money versus out-of-the-money options, and depending on market conditions, we may opt for one versus the other. The difference being, of course, is that although we have a correlation between stocks, so if we get continued downside movement in stocks, we have the potential for downside movement here on YUK, but we also, from a technical perspective, we have potential for downward movement on YUK. Even if stocks start to consolidate a little bit, we may see some of that, the global risk issues that we're dealing with continue to push traders out of the yen, even if stocks start to flatten out a little bit. So it's exposure to an investing class that we might not otherwise have access to just through equities alone. Here's another example. I'm going to bring up BPX, which BPX is the symbol for the index of the dollar pound. What that means is that if we're looking at BPX right now, I'm going to zoom in just a little bit, so you can see historically we're at some pretty extreme highs here. And what BPX measures is how much of a pound a dollar will buy. So since the middle of April, basically, a dollar has been buying more pounds than it did. So and why is that? The pound is getting weaker. This is one of those ways in which, one of the things that's driving stocks down right now is the uncertainty coming out of Europe, right? And England's not immune to this problem. In fact, they have a lot more exposure to it potentially than even the United States does. So as we have these uncertainty events happening in Europe, we may actually see things in stocks start to calm down a little bit or even start to consolidate a little bit. But Europe continue to suffer, and that would be bad for currencies in Europe. That's the euro as well as the pound. In addition, we've got, of course, the big story every day lately has been this problem with BP.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.